I'm back. Welcome to the Arizona Real Estate Update. Rick helps real estate, where real estate in Arizona is stable, not on life support. Got some interesting numbers today. I guess the best way to describe things is this is more like financial theater. Everybody's waiting for the Fed announcement tomorrow after the meeting, about 2 p.m. Eastern time. Are they going to go up 0.25, go up 50? Are they going to be flat? Are they going to lower it? It's kind of like watching football and listening to the commentators. Are they going to run? Well, I think they're going to. I think they need to punt. No, they could pass. So we're watching and seeing here. There's an article here. It says the Fed will either pause or hike, run or punt, interest rates by 25 basis points. What are the pros and cons of each approach? So this article goes through and talks about what's going on, but it basically said that there's a case against a pause. There's a case against a 25 basis point hike. There is all kinds of opinions on what all of this could mean. And right now we're looking at mortgage rates. Kind of had a little up and down session. Went down day before, went up yesterday. Pause would be great for the stock market. Yeah, I think right now, Tyler, the market has priced in. Now, I'm no bond expert, so as you all know, the market has priced in 0.25%. So that's what the market's anticipating. 60, I think the survey was 67% of bond traders said, yeah, they're probably going to go up 0.25 point. Huge difference from what we were facing last week, but because of the actions the Treasury has taken and the central bank has taken, such as this, Federal Reserve and other central banks announced joint liquidity measures. Everybody's working in concert to keep banks liquid. Then this is, kind of taking out the jitters. And it says, apart from the Fed, other central banks participating in coordinated action, including Bank of Canada, Bank of England, Bank of Japan, and the European Central Bank, and Swiss National Bank. The network of swap lines among these central banks is a set of available standing facilities that serve as an important liquidity backstop to ease strains in global funding markets. So there are some measures in place that keep us from falling off a cliff. Now, I did get, I saw an article this morning that's saying that house prices are finally below last year levels, and it's making, big headlines, and it's kind of a well, duh moment. I've got it here. You can see that this is where we're at here, but last February would be right. Let me turn off my little pen here and make sure I'm in the right spot. So there's February. So February to here, you can see that we ended up in negative territory. But you can also see that we're kind of starting to creep back up. Not by much. But as we look at the Cromford Market Index, they do make the comment here that says, in the last 3 days, we've only seen a rise of 0.2, a significant slowdown compared to a week ago when we were at 0.7. So the Cromford Market Index is a mix between supply and demand. They have their own proprietary formula on this. And basically, they're saying that the mandate index, which peaked at 83.5 on Friday, still way below normal level of 100, fell back slightly. Now, they're saying it's not really because of interest rates, because there's just some jitters in the market. But when I look at my 7-day moving average, I'm not seeing that. Of course, I don't have the reams of data that they have. I'm just pulling out things from the multiple listing service and tracking contingent sales and pending and under contract accepting backups. So as you can see, and it's kind of hard to see because I don't have this blown up, but let me go ahead and blow this up just a hair here for you. If your eyes are as bad as mine, this chart is killing you. Right here, you can see we did come down, but the past week we've actually kind of stayed here at this 3,100 level. So Cato here says 6% flat on a 30-year fix would get the party started. I think so, because when you're at 6% on the average, Cato, there's a lot of other lenders out there that start getting down into 5.7, 5.8s. And except for the big retail banks, they'll probably be higher. But I'm seeing that new listings have leveled off. I'm seeing that sales have kind of plateaued, but that's just over a few days. So I don't think any reaction by the Federal Reserve, any announcement tomorrow is going to have, it's just not going to have an effect on housing unless they do something just dramatically stupid. Hard to tell, but it's not like people are sitting around going, well, I'm going to wait. There are people that are having very serious conversation with their lenders going, do I lock? Do I not lock? They've got under contract and now they're, well, let's wait a week. Well, do we want to wait a week? So those conversations happen. So they watch the bond market very closely. As you know, Pat tracks it. He's told us that we're going to trade in this narrow range, and we did for quite a while. But you may recall where he actually said, but there's a breakout moment. So if we break out of this support line, then we could fly down, and treasuries broke out of that support line and rates went up. So that's the difference between being a technical trader and people that follow the news. But we definitely broke through a support line. So saying that rates are probably going to stay stable for a while and everything worked for a little bit because there wasn't a whole lot of news floating around. There was not a banking collapse. So now that that's happened, things are kind of bouncing a little bit. We've certainly seen it far worse in the past. So what we're looking at now isn't too alarming. Here's the demand index. I've got a few cities here. Let me pull off Peoria, and here's Surprise. So their demand index has gone up a little bit. Good morning, Jackie. But Chandler's has gone down just a hair from 67.4 to 67.2. That's what, 2 houses. So I'm not seeing a lot there. Gilbert is actually creeping up a little bit. If we look at Peoria is up a little bit. Let me get rid of a Surprise here because it's muddy in the number. Well, it wasn't Surprise. It was Gilbert. So there's Peoria. You're not sliding down. Queen Creek. Now remember, these are demand indexes. So, you're kind of flatlined versus last week. None of this really tells you a whole lot except for the fact that the wheels are not falling off the wagon yet. So there isn't anything that you need to be too alarmed about. As we were looking at our monthly dollar volume, the dollar volume has come up since February, and it's flatlined right here. You can see, right? Let me draw a little circle around there, right there. The red pen is doing its job today. So that's actual monthly dollar volume. In other words, the price of the houses. But again, this doesn't take into consideration any concessions that are being offered by sellers. And quite honestly, I saw a presentation by the Cromford people the other day, and she was saying if you bought a little over 2 years ago, you've got your home value has gone up 80%, even if you take the big dip that we've had from February. So they've got money to work with. Redfin, Gilbert, 473 listings and 390 under contract. Huge change. Yeah, Mark, isn't that something? You've got, they're moving. And I think, yes, let's celebrate the red pen. You know what fixed that, everybody? It's kind of like a computer. Well, turn it off and turn it back on again. Turn it off, turn it back on, voila. That's all I had to do. You live by the tech, you die by the tech. But Gilbert and Chandler, it is very, I want to say, brisk. Providing there's also a market out there for people still looking for homes that are pretty beat up. And the buyers are willing to throw some money in them to get them fixed up. There's a lot of buyers out there that are pretty handy. The problem is some of the homes that really need to be fixed up, the sellers are trying to sell them at what I would call peak retail, like it's the belle of the ball. And you're just not going to have that success rate. I know there's one house we're looking at. It's off the market right now, but I knew it would fall through. I mean, it needed everything. I mean, the seller was there when we were looking at the house. She goes, well, if I were you, I'd get a new roof. If I was listing agent, like, oh my God, we can't have her there anymore. So we took that into consideration in our pricing, but they had a offer on the house, and she kind of said, no, I'm selling it as is. Well, it's not priced with as is pricing. And so we're kind of on the sidelines, just like the Maricopa home, waiting in the wings. It's off the market temporarily now. Let me know when she puts it back on, and we'll take another peek at it. To restore affordability to pre-pandemic levels, and if interest rates stay around 6%, where would median home prices need to be at? So you kind of have to look at it. Always ends up being a really complicated formula. You have to look at the average wage and look at the average square foot, and you kind of get an index. And I just don't monkey around with that very much. I know there is a national affordability index that's on the Federal Reserve site that I can pull up. It doesn't really tell you that much because the chart just kind of moves in a narrow range. The challenge is that if rates get below 6%, then affordability is going to go in the wrong direction. And pre-pandemic levels, I mean, it's I don't know if we're going to get there again. I mean, I know that's what he's hoping for. And if I take a look at this average by city, and take a look at this chart here, what does pre-pandemic levels mean? That means right down here. I don't know. You tell me. That this was quite the fall here, right? Very fast, but then it stopped. So is there a catalyst coming that's going to pull us down to here? Because that would be a bigger dip, much bigger dip than what we saw in 2008. And that was when we not only had 58,000 active listings, but we had somewhere around 30,000 foreclosures. Today we have, I think, well, let me not guess. Let me see what I can find out here. What do we have in foreclosures? And we did not discuss this at our realtor manipulation meeting the other day. Somebody asked me where we had that meeting. And I said, Golden Corral. You gotta have that mac and cheese. That's just okay. Foreclosures pending right here. I hate macaroni and cheese. Oh, come on. Spit up a chart here. Trying to show you some live info here, and it's messing with me. Well, look at that. See, there's no pending foreclosures. Try another one here as we get here by the topic, and we look at by topic inventory. Boy, here we got it. Monthly chart. Let's try that. Okay, here we are. Sorry about that, folks. Jackie says 54 last month, so that makes sense. And these are pre-foreclosures, though. Notices of trustee sale. In other words, hey, you're behind in your payments. We might have to have a trustee sale. You're getting a letter. You're 90 days late. That's a notice. Right now, homeowners get those, but they've got enough equity that they're not going to hand it back to the bank. They're going to call an agent and say, put my house on the market. I'm behind on my house payments, or they're going to find an investor to come in and buy it because there's so much equity. There's absolutely no reason to hand it back to the house except for the 28 that did, 28 that did in trustee sales. So not a big number. And Cato's saying those hot buttered buns. Oh, we're back to Golden Corral. Yeah. Let's we'll have a meeting there. What do you say? I work in loss mitigation at Mortgage Servicer. Interesting. And there are way more programs available today compared to the 08 era to assist borrowers from losing. Great point. Back then, remember, you lost your house because your payment went absolutely through the roof. You had this adjustable rate mortgage. You're sitting there. Values kind of started coming down. You bought it for $275,000. And even if it stayed even, you're going to have to pay 6% to sell it, maybe 5%. And now your payment went from, $800 a month to $1,500 a month. Well, geez, what's your choice? You had this big payment reset. Well, now you're sitting there looking and your equity has gone down. What's your choice? Well, your payment didn't go up. And if you did have an adjustable rate mortgage, there are programs there where you can get a hold of the bank and say, well, let's do all we can to keep you from handing back to us. Like Keenan said, loss mitigation. So all those programs are in place. We had the forbearance program, which actually turned out to be pretty good. It started out to be a disaster because when they said, okay, you don't have to make your mortgage payment right now, and we'll just add it on to the rest of the loan. And they said that it wasn't going to hurt your credit, but in reality, they were reporting it. So Congress got involved and said, hey, that's not a late payment. Pull that off. So they pulled off your late payments. It didn't show, didn't hurt your credit report. And then at the end of the forbearance period, you had a balance of missed payments. They tacked it onto your current mortgage and then recalibrated it, mostly with a lower rate. So it avoided this huge spike in foreclosures. See that? That's where we were in 2008. But again, there's, I hate to beat a dead horse here, but I just don't see it. There would take an awful lot of calamities for us to get there. It's always a possibility. If we had some, right now you got small regional banks that are kind of having some hiccups, but central banks coming in to make sure that they're shored up. And I'm not seeing any of the big boys having a problem. And some services were automatically being added without even asking. Yep. Yeah. It's kind of, 08 was a mess. And the other problem with 08 is nobody knew who owned the loan. They all got bundled up and sold as derivatives. And so you were mailing your payment to a certain address, but nobody really knew who owned the loan. So when it came to foreclosing on your house, people were staying there for a year because they didn't even know how to get a hold of them, tell them that they needed to take control of the house. So it was a very odd and interesting time, but it was also very depressing to drive around these neighborhoods and see the grass up to your knees and all the dilapidation and the way people destroyed homes. That's what bothered me the most. We just saw the ugliness in some people. They spray painted the inside. They took all the fixtures out. Look, you couldn't make your payment. I get it. But you didn't need to destroy the place. So I was quite disappointed in a lot of the actions that I saw that were out there. Now tomorrow, so the Fed is still meeting today and they're trying to figure out what they want to do. Like I was saying the other day, they're between a rock and a hard place. Inflation, that's their target. That's their goal. But I don't think they're going to see, say banks be damned. So they got to do this delicate dance to say, well, let's kind of keep this liquid. We still got to pull back inflation. Let's see what we can do. So they're going to be looking at a lot of numbers and a lot of data that you and I don't see. And then they'll just tell us Wednesday. And Wednesday will be more about what they say versus what they do. So you're really going to have to listen to the language. And that can be like watching paint dry. But it could tell you some things. In other words, well, we're going up 1/4 point now, but we do see reasons why we may pause for a while. The markets are going to take that into consideration and go, oh, okay, they're going to pause. Or they could say, we see no reason to take our foot off the pedal because we fixed our current problem that we have here. Who knows? So I know I'm going to tune in for it tomorrow and see what happens. So until then, everybody have a terrific day. Take on the rest of the week. And it's supposed to start raining again tomorrow. Did you know that our reservoirs are 93% of capacity? And the reason that they're letting water out of them right now is to make room for the spring runoff. So they're at 93% of capacity, and we haven't even had the spring runoff yet. It's beginning now. You get up and look at pictures of Christopher Creek up by Payson. That thing's just raging. So the water's coming, folks. So that's a good thing. Couple more comments here before we go. Thanks. Oh, you bet. Always good to see you guys on here. I appreciate it very much. Everybody have an excellent day. Talk to you tomorrow.